What are the Basel Accords in financial regulation? Have you ever wondered how banks around the world manage risks and maintain stability? The answer lies in a series of international agreements known as the Basel Accords. These frameworks were created by the Basel Committee on Banking Supervision to strengthen banking regulation and supervision globally. Their main aim is to ensure that banks have enough capital reserves to handle any losses, which helps keep the financial system stable and reduces the chances of bank failures that could lead to larger economic issues. The evolution of the Basel Accords can be broken down into three key phases. The first phase, Basel I, was introduced in 1988. This was the first major agreement on banking regulation. It set a minimum capital requirement, stating that banks must hold capital equal to at least 8% of their risk-weighted assets. The focus was mainly on credit risk, which is the risk of borrowers not repaying their loans. Basel I aimed to create a standard that would prevent banks from taking on too much credit risk without having enough capital to back it up. By the early 1990s, many major economies had started to enforce these rules. The second phase, Basel II, came out in 2004. This version expanded the regulations to include not just credit risk but also operational risk and market risk. Operational risk refers to risks that arise from failed internal processes or systems, while market risk involves fluctuations in market prices. Basel II encouraged banks to develop their own internal risk assessment models and emphasized the importance of supervisory review and market discipline. This meant banks had to disclose more information, which aimed to improve transparency and risk management practices. The third phase, Basel III, was developed in response to the global financial crisis that occurred from 2007 to 2009. Basel III introduced stricter capital requirements and new measures like the leverage ratio, which limits excessive borrowing. It also included liquidity requirements to ensure banks could meet their short-term obligations. The goal of Basel III was to improve the banking sector's ability to withstand financial shocks and enhance overall resilience. Together, the Basel Accords representing a continuous evolution of banking regulations that respond to lessons learned from past financial crises. They have been widely adopted by countries around the world, shaping how banks manage risks and maintain their financial health. The Basel Accords illustrate the importance of international cooperation in creating a stable financial environment. They guide banks in capital planning, risk assessment, and reporting, which ultimately influence lending practices, investment decisions, and economic growth globally.